What's up, everybody? Michael and Coco here. You're watching episode 20 of the Weekly Scan.
The Weekly Scan.
The Weekly Scan is all about finding opportunities in the stock market for the weeks ahead. In today's episode, we use technical analysis to review 7 different stocks. And as for a quick disclaimer, these videos are for entertainment and educational purposes only. Everything that you see in this video is just our opinions. Now, if you're new to this channel because you saw me post a video on TikTok showing my results of my small account challenge turning $500 into $5,000, please know that those results aren't always typical. Now, recently, the stock market has been on one heck of a tear, which makes me look like some sort of stock market wizard. But the reality of it is, I look for high probability setups using technical analysis to take more educated risks when trading the markets. If you do not have experience investing, swing trading, or day trading, I highly recommend you just take notes during the video and then paper trade by using not real money, especially if you don't have the money to lose. As day traders and swing traders here at this channel, our #1 focus is risk management. So we pay very close attention to risk. As you'll hear me state over and over and over throughout this video, let's go ahead and hop right into it. Shit. Welcome to the computer. We are now going to go over 7 different stocks that I have placed on my watch list. I'm going to walk you through how I personally would go about trading them. Once again, always focus on risk management, not about how much money you can make. If you focus on risk management, when you take little losses, you should be actually happy about that versus staying in a position and taking huge losses. Because eventually, if you take little losses over and over again, you will have a stock that really does take off, which will mitigate and get rid of all those losses. So always keep that in mind. Now, the majority of these stocks are of a beta of over 1, which means that they're more volatile. And how you can kind of measure that, a little trick, is by looking at the y-axis from one number to the next. This is a linear scale here. So if you go from $9.50 to $10, that very small move, and look at these candles, they typically extend that big, if not more, every single day, is 50 cents per share. So if you bought 100 shares and it moved this much, what would that equal? Well, that would be a $50 move. So keep that in mind. Know what you're risking before entering into any specific trade. All right, enough of that rant. Let's get into the stocks. All right, here is ticker symbol DVAX. Now, what I see taking place is a lot of volume on this big breakout. The RSI indicator is saying that it's overbought, meaning that the move can be potentially overextended and we might see some sort of a pullback. So this is not something that you want to chase. You don't want to just buy into it with hopes that it goes higher. How I would play this, I would look for previous areas of resistance, and clearly this $9.75 level right here looks like it got hung up a few times. As you can see, it kind of formed this little tiny cup, this little tiny handle. I mean, you could call it a cup and handle, you can just call it, you know, ascending triangle, and you call it a bunch of things, kind of look like that, and then it kind of had resistance multiple times at this $9.75 range. Look at 974, 976, and then finally when it broke above it on big volume, that is a good confirmation that this move can potentially continue. So how would I play this? Well, I would be patient, set an alert on a watch list saying that if the price can come back to say $10 to alert you, because you might within that time frame, it might pull back to that 975 level. If it pulls back to 975, you might see a bounce back from there, because typically when you see a big breakout take place, you might see a retest. It's likely to see a retest take place, and if it does bounce from the retest level, that is a more bullish indicator that the price can go higher. So how would I play that? Well, I would enter in probably about $9.81. I would have a tight stop loss. Okay, so calculate what you'd want to risk. I would buy in right above here, right? So $9 and some change, or $9 and about 81 cents, or $9.75 if you want to be that good. And then I would probably just have a stop loss underneath the breakout candle, which is, it looks like $9.50. So I would have a stop loss at $9.48, just right under that 950 wall. Now, if that's the case, it comes down and bounces up, you have a good risk versus reward trade there. You'd be only risking about that much, this little blue dot here, to potentially earn what our target would be. I mean, it looks like the price got rejected right about $12.50. So I would say the target, just to be safe, could be $11.50 would be a good target to me. So boom, or $12. So you'd only be risking this much to potentially get a move from that price all the way up to about $11.50 per share. So you risk a little to potentially earn a lot. That makes sense to me. Now, it doesn't mean that I would just sell all my shares at this particular point in time if it reaches there, but what I might do is mitigate a third of the position, potentially even more of the position, and then let a smaller remainder work for me. Because if it does continue to go higher, you need to be very patient when it comes to getting out of a trade, but you need to be very impatient when it comes to exiting a trade. So always keep that in mind. Always have a stop loss. Don't risk more than you're willing to lose. Makes sense. Let's go to the next one. Here is ticker symbol WKHS. Now, what I find interesting about here is if you look at the volume from the previous kind of run up right here, you notice a big volume accumulation and then it kind of just dies off. So this right here could be a potential signal saying that, hey, we had a big run up, this was a breakout moment, and now we're seeing a consolidation take place. And this consolidation I like because it's forming somewhat of a, I would say a descending triangle, so you need to be careful with this. And it's in bullish context overall. You have the 50 period moving sloping up and the 200 kind of even but sloping up. So how I would potentially play this play is I'm looking for a breakout above this trend line, but I would like to speculate that it would break out eventually. And here's how I would do that. So it looks like that $14 range. Notice how this one came down and tapped at $14.11 and then bounced up. Then it came down $14.20, then $15.02. So this $14 range right here looks very interesting to me. I would say that I would wait for it to come down to $14 because if it could come down to $14, it'll set up for a good risk versus reward trade. You can have a stop loss, at $14 or $13.90. So you can risk about 10 cents per share to potentially, if you get another breakout moment on high volume, this thing could rip up easily to this target range of, I would say, $20. So $20 would be the target. And the reason why I would say $20 is because it had hesitation here, then it acted as a support there until it broke down. So you'd be buying in at about $14, risking 10 cents to potentially see a bounce up to $20. That's $6 per share. That's a huge move. Now, keep in mind, if this breaks down, it could break down pretty aggressively, all right? So, and then look at the y-axis, you have $11 right here and then $12. So this little small move is $1 per share. So if you buy 100 shares, that little tiny move, which it typically acts that much in a day, would be, $100. You'd go down $100 or up $100 with a small move. So monitor your risk, like I always say. Another thing to keep in mind for the new viewers is that if you have a stop loss at 1350, let's just say, and you get entered in at 1405, if the next day that the stock just all of a sudden crashes down and opens like a gaps down and opens up at $9, your stop loss is not going to get triggered over here at the $13.50 marker. It's going to get triggered at $9. So that's why I always say don't lever up on any one particular stock, because if you do have some sort of just aggressive gap down and it hops over your stop loss, you can get really wrecked with that. Now there's other orders you can do, like a stop limit, but I'm not going to get quite into that. If you want to look into stop limits, you can do that. In short, basically, if it hops over your stop loss, it won't get triggered, but it will get triggered if it reaches back up to that level. But I'll let you look into that if you want to. I don't really use stop limits all too often. Now, the reason why I said the gaps, watch out for the gaps, is because as you can see, the stock right here on this day opened up here, closed here, but then look at where it gapped down to. It opened up right here. So from this area, which is $18, it opened up the next day at 16. So imagine if you had 100 shares of that and you just wake up and it's down $200. So that's what I mean about gap up and gap downs. However, this stock, I like the volume accumulation. I like how it's kind of going sideways right now, or kind of consolidating on lower volume. So I do see this as a good risk versus reward trade, and the target would be that $20 level if I can get in right around here. So let's move on to the next one. Here is ticker symbol ELY. This is Callaway Golf. Now, this is one of those other ones that I would say, wait a little bit to see where the price goes. And the reason why I say that is because that candle right there signifies a potential reversal coming before maybe a breakout. So as you can see, the price is getting hung up right around $18. However, if you look at the price history, it's been kind of going up. right? So this is what's called an ascending triangle. You have higher lows taking place as you get those pullbacks. Now, right now, it's kind of reached up to that $18 and got rejected again. It's right above the 200 period Godfather moving average. It's kind of going sideways, so it's not giving us too much data. Then you have the 50 sloping up pretty steeply coming into this range. So this overall looks like a good setup, like it can eventually break out of the $18 and move higher. However, I would just want to wait a little bit to see where this price can come down to, because this type of candle on this type of move up looks like it could have a potential pullback. So you have the 200 period moving average right here, and it does look like it can act as a support area. So if you wanted to, you can be very patient and wait for, like, maybe it might come down to $16.50 and then have a stop loss just kind of below that, or potentially below the 50 period moving average, wherever it lies at that particular time. And then you're speculating that you'd see a breakout eventually of this $18 to move potentially higher. Or if you wanted to be a little bit more aggressive, you can just kind of buy in right by the 200 period moving average and have a stop loss underneath it. So for example, the 200 period moving average is at $17.19. So say if you bought it at $17.22, and then you're like, okay, if it goes under $17, I'm going to get stopped out. So $16.97. So you get stopped out there, and then you can say, okay, but if it reaches $16.50, that's when I'll buy back in again. So you basically would just like risking a little right here, and then just to speculate that, hey, no, I still think the price might break out. Or and then you could really get back in right here lower, or just be patient and wait. But overall, I do like this type of setup. I just don't like this candle right here. So be patient on this one, put it on the watch list, and just kind of see what takes place in the next couple of days. Let's move to the next one. Here is ticker symbol CYTK. This came up as like a #1 on not only volume, but on the volume hammer candle kind of scan that I do. And it's just interesting because you had this big gap down. So pretty aggressive panic move to the downside, but then a hammer candle on a downward move like this indicates potentially a bounce. And what I like about this is it not only bounced or created this hammer candle right here, it did so by the 50 period moving average and the 200 that's sloping up, a nice big gap between the two. So it's in bullish context on this pullback. On top of that, it has high volume. And on top of that, at $23 right here, notice the bounce point. It came down perfectly to an area that was once resistance right through here. And then when it broke through, it acted as support. So right now is a really good risk first reward trade where you can enter in, depends on where it opens up Monday. I always like to get in kind of lower just to minimize my risk. And then I would have a stop loss probably underneath the 50 period moving average. And my target would be, I would probably mitigate around $26, maybe 25, because 23 to 25 is a pretty good move. But my main target, I would say, would be $28 to about $27. So right around, I would say there would be a more ideal target. $27 would be the ideal target. So you'd be risking this much as blue dot to potentially earn that much. So that is a very good risk versus reward trade. And like I said, I might mitigate right here at 25, take some shares off of the table. So for example, if I bought, just for rounding purposes, 60 shares, I would say I would take off 20 shares here, 20 shares at 27, and then I would let the 27 other remaining shares work for me. And I would always constantly, I wouldn't just keep my stop loss right down here. I would move my stop loss as time progresses, just so I can make sure that it's always a winning trade. So for example, if the price did come up to $27, I would have to see what those other candles look like to help get it here. But I would move my stop loss as time goes underneath the remainder candles to basically lock in more and more gains as time went by. All right, let's go to the next one. Here is ticker symbol TNXP. This popped up on my dark money scan. And if you haven't seen my dark money scan, I actually teach you how to scan for these type of stock setups. And this is what I kind of see right here. If you go to 72 or 0.725, and you just kind of look back through the history of the chart, you can notice that it acted as support here, then resistance, then it got chopped up. More data points right here, resistance, more data points, more data points, more data points, more data points. So this 0.725 area does look like a very solid breakout area, and it broke out on very, very high volume. Now, this is not the type of stock you just want to jump into while it's up here, because if you look at this long upper wick right here, that's people that bought in right here to push the price higher, and then the price came down. So you got a lot of people kind of trapped in there hoping that the price goes. That's kind of like those FOMO traders. So how I would go about this is I would just wait for the price to come to you. So set an alert at 70.75, so 75 cents. And if it can reach a little bit lower to this, 0.73, let's just call it. So 0.73, so we get a pullback, and potentially that would be a good risk versus reward trade where you can have a stop loss underneath that support line, and you basically hope for a bounce from that point to go higher. That's how I would trade this one. As far as a target goes, I would say a target would be 80 cents right there, and that's just because if you look at the previous price history, there's also areas that it got kind of hung up on right there. So I would say if it bounces from that area, I'd take some profits right up there and then let a couple remainder shares work for me. All right, let's go to the next one. All right, here's ticker symbol AG for First Majestic Silver. Now, this isn't as volatile of a stock, and this is one of the minor stocks, and it is a silver mining company. And I really like these silver miners because of how the price of silver has been working. Now, if you didn't watch my special edition weekly scan where I just went over miner companies, this may or may not have been in it. I don't think it was, but what I like about this stock right here is a couple things, okay? So first off, the current pattern looks like a cup and handle. So you have this kind of cup right here, and then you kind of have a handle breaking out. And then it's at a very interesting area, I would say $11, maybe even a little bit lower, like $10.75, but let's just call it $11 to round up. Notice how it's acted as resistance basically right here, right here, right here, and it's getting hung up on that price. So what I would do personally is, first off, this candle right here is an inverted hammer, so it looks like it wants to pull back. If it pulls back to the $10 range, that's where I would set my targets on, where I'd want to buy in, because this cup and this handle kind of pattern could go for quite some time. So you got to keep that in mind while you're trading. But this inverted hammer candle, I don't know if it's going to pull back a little bit more or not. So you just got to kind of be patient. Or you can wait for a breakout of the $11. Now, me personally, I'm bullish the miners, and I'm bullish silver, I'm bullish gold. So I do think that this price is going to be breaking $11 in some point in the near future. Now, that could be just a bias that I have because I'm just bullish gold and silver. But there's a couple things on the chart that I like. One, like I said, this cup and handle pattern, okay? The next, I like this golden crossover is kind of taking place, meaning the momentum is shifting into the bulls direction. The context of the chart is now getting healthier for the bulls. The next thing is there's some volume accumulation here, nothing too crazy, but it is something to keep an eye on. So there is, you have some pretty big volume candles coming in here and there. So you might start seeing volume spikes, and that's what you want to watch out for. Is if you start seeing big run-ups in volume, that might be the early indicator saying, hey, we're going to be coming for that $11 area, and we're going to be breaking through it. Now, if it does pull back to that $10 range, I like to let this kind of stock work for me over. This would be more of a longer term trade, but I would have a stop loss probably under the 50 period moving average, because I know that here it acted as support, and then over here it did too, and then over here it did too. So I would follow the 50 period moving average up. And I know that the 50 period moving average is moving up because the price action is above it. So every day that passes above the 50 period moving average, the 50 period moving average is going to be moving higher. So that's how personally I would trade it. Another thing that you can do if you're a long-term investor and you believe in the price of silver is you can just pretty much buy in right now, and then if it pulls back, you can buy the dips, and then sell the rips, right? So I'm looking for a breakout of $11. I just might need to be very patient on this one. Let's move on to the next one. All right, here is the last ticker symbol, INO. This is a very volatile, fast-moving stock. Like I've been saying, look at the y-axis to kind of get a good glimpse as to why I say that. This little small move from this y-axis point to this y-axis is $2 per share. And if you look at the candle size, they pretty much all move about $2 per share every single day. So monitor your risk. This little tiny move, if you buy 100 shares and it moves $2, that's $200. If it moves from 30 to 34, that's $400. So only enter into this with how much you're willing to obviously lose. But here's the pattern, and here's why I think it's a pretty decent setup. First off, volume accumulation over here. That's nice. You saw that big breakout up into this range, the $33, $34 range. Then you see this kind of consolidation take place, which is nice. Volume is kind of shrinking. However, this last day is saying kind of like peekaboo, a little bit more volume is stepping up into play. Now the pattern is I would say a symmetrical triangle. So you have it kind of going like this, and then you have the price kind of going like that. So this candle, it might be saying, hey, it's ready to start peeking its head out and break out to the upside. Now, if it does break out to the upside, where would the target be? I would definitely consider $32 as a target. So that means if it breaks out from this, you know, it's at $26.97, so let's just say $27 it's at right now. 27 bucks to $32, that's $5 per share move relatively quickly. That is a pretty darn good setup. Now, like I said, be very careful on this because it's a fast mover and it could very well just go down the next day. So see where it opens up Monday. I would be paying close attention as far as a area of a stop loss. I would say pay close attention to this $24 because $24 looks like it has some price history on it. Notice how it acted as support here, then resistance, and then support again. So I would say if you can get shares a little bit lower, more towards the 24, and then have a stop loss under it, that'd be more ideal. Or you can potentially play a breakout of this trend line and then target up here at $32. So there's a couple different variations of how you'd want to play this. Just know that it is a very fast, very volatile moving stock. So, you know, if you don't want to risk that much money, then just lower the amount of shares that you purchase to mitigate or to compensate for that. All right, that is all I have for you on this week's weekly scan. I will see you on Monday when I do my S&P 500 technical analysis updates. See you later.